our story, it starts with a flashback of how the economy did in 2020, from stock markets to crazy GDP charts, to unemployment, to rent growth. Let's set the groundwork for the mega trends that I'm going to share. So I'm a real estate guy, right? So I start with what affects my investor profits the most, rent growth. Before the virus, rent growth in the US was rock solid at 3%, with all three types of assets at or above rent growth. In fact, annual rent growth had been growing for a record 39 consecutive quarters, almost 10 years. Occupancy was at an all-time high. All was well, and then all hell broke loose. The virus plunged us into a recession, killed 550,000 people, caused catastrophic damage to our services industry. But for once, Congress responded, and they responded spectacularly well with the initial CARES Act. So with the Fed's interest rate cut and the trillions in stimulus, we saw the stock market and the real estate market go absolutely bonkers. Today, the S&P 500 is above 3,800, its highest ever, despite a second resurgence and then a third resurgence of the virus. And I know a lot of you out there on the webinar are going to say, but Neil, the stock market doesn't make any sense. Millions of Americans are out of work, so the stock market's too high, it's going to crash. Well, I have news for you. The stock market is actually right where it should be, and I'm going to prove that to you in less than 5 minutes from now. So the numbers in the stock market do make sense. You just have to dig a little bit deeper. And the first place we're going to dig is GDP growth. The US gross domestic product here in this big bar was negative 33% in Q2 of last year. That's the highest decline on record. And I see that in news articles and on the TV all the time. You know what I don't see often is that Q3 GDP growth was not negative. It was positive 33%. As you can imagine, that is by far the best growth ever in history. All in all, Q2 and Q3 actually canceled each other out. And while that may not make sense to you yet, I promise that it will in a few slides. So, okay, GDP balanced out, but many industries were hit hard, Neil. The 4 largest US airlines, they lost 25 billion. The NFL lost 38% of their revenue. So many sporting and event venues have been closed, but nobody was hit as hard as the entertainment industry. Both the largest and the second largest theater chains in the US are going to be closing. And the government responded to this incredible pain with the largest stimulus in US history. $2 trillion were injected, then $1 trillion, then another $2 trillion, $5 trillion. That's a whole lot of zeros. And the Fed didn't stand back either. The Fed's balance sheet increased by more than $3 trillion this year. The Fed bought government debt to help the politicians pay for the different CARES Act. In all, the Fed provided almost 4 times the subsidies, more than 4 times the subsidies that were provided in 2008. And those subsidies, by the way, have yet to be paid back, in case you're wondering. They also lowered interest rates to 0. And as you will see in a few minutes, that lowering has had some unexpected benefits that we're going to enjoy this year. Now, let's take a brief look at unemployment, right? This recession was wildly different from previous ones. In this chart, you can see the first 52 weeks of the last 5 recessions in this cluster here. And as you can see, a year after they started, there are roughly right here, 20 million, 30 million unemployment claims in these 5 recessions. The orange line is the 2020 recession. Only 31 weeks into the recession, we were already at 66 million unemployment claims. That is a stunning number. Another thing that was bizarre about this recession was how uneven it was, right? Hawaii, for example, is at 15% unemployment. This number is about a month old. Nevada at 13%, but 14 states in the union were under 6%. Now, most of these states in the last month have actually moved to under 5%. So you can see the uneven nature of this recession. And also the recovery has been bizarrely uneven, depending upon education level and also income. On the left here, you can see that people with less than a high school diploma, basically low-wage earners, they were the most affected, followed by people with high school diplomas. By the time we look at people with bachelor's degrees, green line, there's practically no difference in employment between Feb and September. See how the green lines moved up the same level? I want you to remember that. Now, on the right, you can see that high income wage earners and medium wage earners, blue and dark blue lines, were also not affected much. By August, these people were also back up to pre-COVID levels. It's the low wage earners, the under 16 bucks an hour, that have suffered tremendously. So to summarize, people with low income and low levels of education suffered the most. Tourism states suffered the most, while many parts of America have lost very few jobs, like Idaho.